On Monday, March 18th, the Schwab U.S. Dividend Equity ETF, ticker SCHD, went through the process of reconstituting itself. What this means is that the fund went through the process of rebalancing, adding, and removing some of its holdings. Because SCHD is an index fund and it's not an actively managed fund that has its holdings updated constantly, the only time changes are made is when the index itself is updated, which is the Dow Jones U.S. Dividend 100 index. The fund rebalances its holdings every quarter, but only makes changes to its holdings once a year. But with the fund's most recent reconstitution, it's brought some pretty significant changes, which honestly shifts the strategy of this ETF in my opinion. So in this video, we'll go over the major changes that occurred with this fund and see what we can likely expect from its future performance. To give some context, the Dow Jones U.S. Dividend 100 index is designed to only have 100 holdings, as the name would imply. So anytime the index wants to add a new holding, it has to remove a holding to allow it to fit. This year, SCHD saw 23 new positions added and 23 positions removed. This is a list of the top largest holdings that were completely removed from SCHD. Most notable were Broadcom and Merck, which made up a combined 9.26% of SCHD. Also deleted was 3M, which I think was a good choice considering their dividend has been under a lot of pressure. But ultimately, you can see that there's a pretty even spread across sectors, including some consumer staples, financials, some technology, and healthcare. This is the list of all 23 positions that were added to the fund. Most notable is going to be Bristol Myers, who now makes up 4.03% of SCHD, and it's its fourth largest holding. So if you notice, they swapped out one of their largest pharmaceuticals, which was Merck, for another. Their second largest addition was Hershey's at 1.21%, which I thought was kind of an unusual choice. But it does look like their stock has a pretty low payout ratio, which is good. Then you can see there's also Cincinnati Financial, Skyworks Solutions, CF Industries, and a handful of other picks. If you add up all the new additions to SCHD, they make up a little over 11% of this ETF. There were also a number of energy stocks that were added to this fund as well. TheStreet.com has this really useful table which shows what changes were made by each sector. The two largest decreases in SCHD were in technology and industrial companies. Technology was never a big part of this ETF because it is pretty rare for tech stocks to pay dividends at all in the first place, let alone any worthwhile dividend amounts. The second biggest decrease was in industrials, dropping from 17.1% to 13.1% of this fund. The largest increases were in energy and consumer staples, which are two sectors that are well known for paying larger regular dividends. I was a little surprised that SCHD completely got rid of all of their utility holdings because this is a sector that does usually pay more dependable dividends. But regardless, the two largest sectors are still financial and healthcare, although both saw slight decreases. This is SCHD's current list of their top 10 largest holdings. You can see it still holds a lot of very popular dividend growth stocks, including Home Depot, Texas Instruments, Pepsi, and Chevron to name a few. On the same day these changes were made, it was announced that SCHD was actually the most popular ETF in the world last week in terms of inflows. It was even more popular than SPY was. So we'll have to wait and see next week if these new portfolio additions are going to result in any sizable outflows or potentially even more inflows. But ultimately, what are the results of these changes? We'll start by looking at some positives. According to the Sunday Investor, who was able to crunch some numbers on SCHD's new portfolio before and after the reconstitution, the new SCHD now comes with a higher dividend yield. Before last Monday, SCHD offered a dividend yield of 3.62%, which at the time was still the highest dividend yield among dividend growth ETFs out there, including Vanguard and Fidelity's dividend growth ETFs. But now after the changes, SCHD now offers a yield of 3.93%. So certainly people who are primarily seeking a higher yield should be pleased with the changes Schwab has made with this fund. Another big positive is that the average dividend payout ratio among all the holdings in this ETF has improved considerably. Before the change, the average payout ratio of every stock in SCHD was 66.15%. Considering this fund does not hold any alternative investments like business development companies or real estate investment trusts, which are required to have high payout ratios, 66% is still pretty high. This I know is a concern for some people, as this was one of the highest payout ratios among dividend ETFs out there. Fortunately, after the changes were made, the average payout ratio has now improved to 54.43%, which is considerably more comfortable and puts them closer to Vanguard's dividend growth ETFs. In my opinion, these are the biggest positives to the changes. A higher yield and a safer dividend is certainly going to be appealing to a number of investors out there. However, there is one major downside to the changes that I think could make SCHD a less appealing investment to some people. It's been pointed out by a few outlets that many of the new holdings inside of this fund have been slower when it comes to dividend growth. In terms of how much slower we can expect it to be is still uncertain. However, back when I did my dividend growth ETF comparison video back in November, I pointed out that SCHD had the highest dividend growth rate out of any other major dividend growth ETF. Currently in second place is the iShares Core Dividend Growth ETF, ticker DGRO, and the Vanguard Dividend Appreciation Index Fund ETF, ticker VIG, which isn't too far behind. As a shareholder myself of SCHD, this slower growth does have me concerned. I've been saying for years that I believe every dividend and income investor should hold at least one diversified dividend growth ETF in their portfolios. This can help significantly in terms of diversification and also helping your income still grow once you make the switch to living off dividends if you're holding higher yielding, slower growing investments. Not to mention the dividend growth also helps in terms of inflation. In my portfolio, I have relied a large part on my growth to come from reinvesting my dividends, so I have relied on SCHD to provide me with some higher dividend growth. It's been well known that SCHD has been underperforming the market and even some other dividend growth ETFs. With the fund now holding potentially slower growing stocks, the underperformance is something that I do consider to be a threat. Still though, holding SCHD won't result in you losing money unless there's some unexpected market crash tomorrow. But this is something that I also think is worth bringing up. It is true that SCHD may face future underperformance compared to the S&P 500, but that's not necessarily a bad thing. Like we looked at earlier, this ETF now offers a higher yield and more dividend safety. Not to mention the dividends paid by SCHD are also more tax efficient compared to other options, so it's better suited for tax-averse people to hold in taxable accounts. One piece of criticism that's common is that many dividend stocks and ETFs, particularly some of the higher yielding holdings, underperform the S&P 500. But this doesn't mean that an investment is bad by any means. If an investment functions in a way that you like, such as a holding that offers a 4% dividend that's much safer with some growth, then that's a great reason for investing in it. If you were to ask someone what's the best car, you're going to get a range of responses. Some will say that the fastest car is the best car, while some will say that a car big enough to carry their large family is the best. Ultimately, what's actually the best investment is what you personally are looking for from a stock or an ETF. Sorry for going off on a tangent, but in the end, the new SCHD isn't a bad investment. If the highest yielding diversified ETF that's now safer sounds like a great choice, then it's worth it for you to consider it. As someone who targets higher yielding investments, but am also looking for more growth from a diversified dividend ETF, I will be evaluating SCHD in the year ahead to see how bad the underperformance might actually be. Even if the new holdings in this fund aren't great, it's worth remembering that they'll likely make adjustments in the next year. So when it comes to holding SCHD, you have to not only be sold on its holdings and its past performance, but you also have to be sold on the methodology that they use to select stocks for its index. I'm not against advising people from staying away from SCHD if the underperformance gets significantly bad, but at the current moment, I just don't have any plans myself of giving up on them, and I think it's too early to tell for anybody to just give up on SCHD. Although I would replace it with DGRO or VIG if significant underperformance does occur, but all we can do is wait and see at this point. Since the changes took effect 4 days ago, SCHD is currently up 1.67%, which is a good sign. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.